In Chapter 4, we are going to look at adjusting entries and creating a worksheet. So we're going to begin with adjusting entries. So adjusting entries are a way of updating the ledger accounts. It's a way to bring accounts up to date to show the actual balances in some of our accounts. These are considered internal transactions, and they have not been recorded before because there's no outside parties involved in this. Okay, so it's not necessarily that we're buying something on account or we're selling services. These are just things that happen within the company, within the business on usually a day-to-day basis that we need to adjust for. And these are typically done after the trial balance is created. So what I like to do is show you how they're done, and then we'll plug them into the next part. Okay. So the first type of adjustment we'll look at is one that goes with supplies. So if you remember, when supplies are bought, the supplies account is debited. Supplies are an asset. So suppose a company buys, 120 pencils, and we'll debit the asset account for the value of those pencils. But as time goes on, those pencils are going to be used up. So we need to adjust that supplies asset account to show that it no longer has as much in it as we originally said. So once the supplies are used, we can go ahead and make an adjusting entry that's going to be a debit to supplies expense and a credit to supplies. So we're saying, okay, we've incurred this expense of using up supplies, and then we are crediting the asset account to bring the value of it down. So here's an example. During June, Connor Whitewater Adventures purchased $675 of supplies. At the end of the time period, the company counted its supplies and determined that it had $215 worth of the supplies remaining. Therefore, $460 worth of supplies were used during the period, and the adjusting entry is shown below. So the original entry happened as a debit to supplies for $675, as you can see here, and then the credit was either to cash or accounts payable, depending how the supplies were purchased. The end of the month has come, or the end of the fiscal period has come, and we went in and we counted the supplies, and we found that we only had 215 left. Okay, so what we need to do is we credit supplies by 460 to bring the balance up to date to show that we only have $215 worth of supplies now. And then we are going to debit our supplies expense. Okay, so that's how an adjusting entry for supplies looks. Prepaid insurance is another one that's going to require some adjustments. So when prepaid insurance is recorded, it's recorded as an asset, and the amount that you record is actually the premium. Okay, and as time goes on, you use up your premium. So once the value of that premium decreases, the asset account of prepaid insurance must be updated to show that devaluing happened. So when this happens, when we adjust for prepaid insurance, we do a debit to insurance expense because it's an expense to the company, right? And then we're going to credit our asset account of prepaid insurance to bring the value down to show it's no longer worth as much. So here's an example. In June, Connor Whitewater Adventures purchased $1,875 in prepaid insurance. This is the premium for 3 months. Okay, so for 3 months, it costs us just under $1,900 to have our insurance. At the end of June, which is month 1, the balance of prepaid insurance must be updated to reflect the consumption of 1 month's worth of premium. It's not worth as much. Okay, so what we do is we take that $1,875 and we divide it by 3. When we divide it out, we see that we're actually paying $625 per month. So for this month, to adjust the prepaid insurance to show that the asset is not worth $1,875, we credit $625. And that brings our balance down, and then we debit our insurance expense. Okay, so again, we're just updating the values of these assets to show that they're no longer worth as much. Okay, and we expense them out. And remember, expense is the cost of doing business. All right, so let's talk about depreciation. So our big ticket items in a business, such as photocopiers, tractor trailers, all that kind of stuff, we don't just, break them up over monthly time and say this much was used and all that kind of stuff, okay? They're considered fixed assets. So fixed assets are durable items such as appliances and fixtures, all right? And they are big ticket assets that our company has. They will last longer than a pencil, right? They're going to last longer than 1 year, but eventually they'll lose value from regular wear and tear, or they'll become obsolete. So the best example I can give is a car. So when you purchase a car, it's worth X amount. The minute you drive it off the lot, it loses an incredible amount of value, okay? But it's not going to be completely useless within a year, all right? So depreciation is the allocation of the cost of equipment as an expense over its estimated useful life. So here's an example, and depreciation is done a little different, okay? So Connors Whitewater Adventures has an equipment account balance of $51,300. All right, so they have this piece of equipment. It's worth $51,300. We estimate that the equipment is going to last for 7 years. So we're going to get 7 years out of this asset. And when we sell it, right, we salvage it, we get rid of it, we sell it for parts, we sell it to someone else to use, we're going to get $8,292 out of it. Okay, so it's not like it's going to come all the way down to zero. It's still going to be worth like $8,000. So we're going to use the straight line depreciation method. So we allocate the cost of the asset less the trade-in value, because it's really not going to cost us $51,300 because we're going to get $8,200 out of it when we sell it. Okay, so we take that trade-in value off of it and then we divide it up over the useful life. So here you see the steps. So you first need to figure out what the full amount you're depreciating is, okay? Because it's not the purchase price. The purchase price was $51,300. But we know when we go to trade this in or salvage it, we're going to get $82,000, almost $8,300 out of it. So when we back that out, we see the amount we have to depreciate is $43,000, $43,008. We take that number and divide it by the useful life of 7 years. Okay, so over 7 years, this piece of equipment is going to lose $6,100 in value, roughly $6,144 per year is going to come off the value. All right, now we then divide that by 12 because we want to do it month by month. Okay, so this piece of equipment, $6,144 divided by 12, is going to lose $512 per month. It's going to depreciate $512 per month. All right, so let's see how this looks. This is big, and this is where students get confused. When depreciation is recorded, it's not subtracted directly from the asset account, okay? There's a separate account. Your big ticket items are fixed assets, so you can't just, say that they're used up like you would a pencil or staples or something like that. You actually have to keep that full value on the books and slowly depreciate it out through what is called a contra account, okay? And the contra account is going to be called accumulated depreciation. And in this case, it'll be equipment. If it was accumulated, sometimes you'll see accumulated depreciation, tractor trailers. It can be as broken down as that, or it can just be the entire fixed asset of equipment, okay? So the entry is going to be depreciation expense equipment. It has a specific expense account for $512, and then accumulated depreciation equipment in the amount of $512. So the equipment account remains at that $51,000, but this accumulated depreciation offsets it. It's just how it's done. It does not come directly out of the equipment account. It is a contra account. All right, it is subtracted out of that value. It comes off, but in a different way. It's not coming directly off of the equipment account. And the last type of adjusting entry we're going to look at is one that deals with wages. So, typically employees are paid weekly or biweekly, and very rarely does that line up with the fiscal period. So the end of the month, let's say. Okay. So what happens is you incur the expense of having to pay the employee, but you don't actually pay them until the next fiscal period. So let's assume the following. The end of the fiscal period is December 31st, which falls on a Wednesday. Okay. Employees are paid every Friday, making the next payday Friday, January 2nd. On December 31st, the following adjusting entry must be recorded. A debit to wages expense, because remember, expenses need to be realized in the fiscal period they were incurred. So we incurred the expense of having to pay our employees, okay? But it's then going to be a credit to wages payable. We are not going to pay them until January 2nd. It's a liability. We have to pay them, but it's not going to happen until January 2nd. And then what happens on January 2nd is we're going to debit accounts payable. Actually, that should say wages payable. Should not say accounts payable. We're going to debit wages payable to take that specific liability off the books, showing we no longer owe it, and we credit cash. Notice there's nothing happening in the new fiscal period with this wages expense. Because remember, expenses, I said it before, I'm going to say it again, need to be recorded in the period they were incurred. Okay, for this one, the period ends December 31st, so we must record that expense there. It's not an expense on January 2nd. All right, so let's look at an example. Assume that Brown Company pays its employees $400 per day, and that payday falls on Friday. So this is the same kind of example. The employees work a 5-day week. When employees pick up their paychecks on Friday, the amount of the checks includes their wages for that day and the 4 preceding days. Okay, so you're getting paid for that day, even though you may not have worked the full day, right? Because you might pick it up in the morning, but you're getting paid for that day and the 4 preceding. Okay, so the Monday, Tuesday, Wednesday, Thursday. Suppose the last day of the fiscal period falls on Wednesday, December 31st. Same example, but I'm giving you more concrete. The wages account shows an accurate balance for the fiscal period. In order to do that, you have to add $1,200 for the cost of labor between the last payday of December 26th and December 31st. So let me zoom in on this so you can see it a little better. So we have December 26th, right? Then we have 3 days here that we're responsible for paying, but we're not going to pay them until January 2nd, which, if you look here, falls into the next fiscal period. Okay, but we need to record these expenses in this fiscal period because expenses must be recorded in the fiscal period in which they're incurred. Okay. The $1,200 will not be paid at this time, but is owed to the employees as of December 31st. And that's where that wages payable comes in that I talked about, which is the liability. So let's take a look at this, what it actually looks like. So we have a debit to wages expense in the amount of $1,200. This note, it's very important to note, and I don't have the date on here, but this is recorded on December 31st. Okay, so we have a debit to wages expense in the amount of $1,200 and then a credit to wages payable. Okay, we incurred the expense and it's a liability that we're going to have to pay off. This is the most difficult for students to understand. When you're looking at examples and when you're practicing this, it's going to say accrued wages. That means it's accrued, you incurred it, but you have not paid it yet. It's a liability. So that's where it's going to look like this. You're never really going to have to look at a calendar and break it up by the fiscal year and do that. Okay, you're just going to have to know when it says accrued wages that it's an expense that's been incurred, right? You've accrued it, you're responsible for it, so you need to record it and then record it also as a liability.